Hey everyone, Signa here with the Bullish Bears. Today we're going to do a video on strangles and straddles and the misunderstanding that a lot of people seem to have with this trade and the problems that people have because of their accounts with this trade. So a straddle is buying or selling a call and a put using the same strike. So you can see down here, this is a straddle. I sold a call at the 288.5 and I sold a put at the 288.5. That makes it a straddle. Now if I sell a call and I sell a put with different strikes, it becomes a strangle. The difference between these two is with the straddle, it just forms this pyramid shape. Okay, and I don't get to define my break-evens. But with the strangle, I can actually change the shape of the pyramid and stretch out where my break-evens would be at expiration. That way, I can try to fit it within the expected move. So for an example, this is a May 19 trade. And if we go up here and we set the calendar to May 19, sorry, this is a May 15 trade, so we'll set it to May 16. You can see here's the May 15 trade that we're looking at. We set this calendar to 1 day later, and it gives us the expected move for SPY, which is what we're discussing. So between now, which is May 11th, and the day that these would expire, May 15th, SPY could move this far. The strangle allows me to move my break-evens to the edge of the expected move, because if SPY is supposed to stay inside of here anyways, that would be where I would want to build my trade so that anywhere in here I could find profit before expiration. The problem that I see a lot of people do with this trade is, first of all, unless you have the account rights or permissions, you can't just go out and sell an option. If your account is big enough to handle the buying power effect or the loss that could incur, you can see here the max loss of selling a naked option is $28,000. Your broker won't let you sell a naked option unless you have enough money to back up the max loss. And so a lot of people, when they hear about trading the strangle or the straddle, they instinctively think that it must be something that you buy. We can look at this and identify right away that this is a very expensive trade. All right, it's $431 to get into this trade. We can also see that when we buy a straddle, we need price to move almost beyond its expected move to make a profit in this trade. So putting on a straddle is only going to be an effective strategy when you buy it if you're expecting a very sudden and sharp move to the upside or the downside. If you're not expecting a very fast move in either direction, you would not ever want to buy a straddle. The strangle would be the exact same thing. We would be going in to buy a call and buy a put. And this again would work the same way. We would need to see a very big move in the market, be almost beyond its expected move, to actually find some value in this trade consistently. But since most people can't sell naked positions, they don't think about selling the strangle and the straddle. They think about buying it. And that's an absolute mistake if you're not expecting a very large move. Now, one of the problems that I see people doing also is trying to use this trade for an earnings event. Oftentimes, everybody looks at the history of a product that had earnings and it explodes to the upside or it gets crushed to the downside, and they think, I'm going to put a strangle or a straddle on like this, and then when it breaks its expected move, I can take it for a ride in either direction that it goes. The problem with that is volatility and volatility crush. So what I mean by volatility and volatility crush is that after a product has earnings, the volatility gets crushed out of the product. And it doesn't matter what product it is. There will always be a volatility crush after an earnings announcement, because before earnings, there's a lot of unknown. And because things are unknown and nobody has the answers, they start to have uh, fears, and they don't know what to do, and that causes volatility. So when you look at a product that's going to have an earnings, we'll go to Campbell's Soup for an example. Any product that you're looking to trade for earnings, you would want to go and look at its implied volatility historically. What has happened after every single earnings announcement for what you're wanting to trade? This is a representation of implied volatility, and you can see that after every earnings announcement, Campbell's Soup took a massive crush in implied volatility. On this date, it went from 42 down to 27. Now we can just look at that 15 points of volatility. If we go to the analyzer and we look at SPY for an example, since we already built the strangle in SPY, and we knock off 15 points of volatility, what happens to our trade? It gets crushed. We fall right into the bottom of the deepest part of the trade. It's the max loss right there. At that point, we absolutely need to see a move to the upside or the downside all the way past the break even to see any profit in this trade. So this is a trade that you do not want to buy before an earnings announcement or for earnings. Okay, this is not an earnings play right here. The volatility crush will kill your position. And that goes for the strangle or the straddle. They are both affected by volatility the same way. Volatility crush will guarantee that you need the move beyond the break even to see profit in the trade. So you do not want to use this particular strategy for an earnings play. You don't want to buy it. Now, instead, if you are looking at an earnings play and you want to sell the strangle or sell the straddle, well, then that's a whole different game. Because now, if we take volatility out of the trade, you can see that it increases your profit potential very quickly. You don't need the product to move anywhere. All you need to do is hang on for the ride and let the volatility get crushed out of the product. So for an example, in Campbell's, after its earnings announcement, this crush in volatility alone, setting aside the fact of the price move, the volatility getting crushed out of this product can make your trade hit a profitable target so that you can exit. You wouldn't want to hold it into expiration. Now, the problem with trying to trade this with a sell for an earnings play is that, just like we were looking at here in Campbell's, when it had an earnings, it exploded to the upside. That explosion to the upside in price means that it could leave this butter zone, so to speak, is what it's called. So then I would be outside of my expected range, and then I'm not in a profitable trade anymore, even though I got the very quick explosive move in Volatility Crush. Right? So everything that we do in the options world, there's balance and equality. Playing a Volatility Crush trade for earnings when everybody knows there's going to be a Volatility Crush is offset by the fact that in an earnings play, the product could absolutely explode to the upside or the downside and cause us to lose our trade. Right? Nothing is guaranteed, and with risk comes reward, or vice versa. So there are no quick gimmicks, no fast, easy ways. There's no way to game the system or get over on anybody. The biggest, best minds in mathematics and science have been hired by the brokerage companies to develop trade strategies. If those people, with all their years of time and experience and effort, have not been able to develop a way to, quote, beat the system, you're not going to develop a way to beat the system. Any earnings play that you ever try to do is nothing more than a toss of the dice or a flip of the coin. It is gambling, 100% gambling. No matter what chart analysis you've done, no matter how much history and fundamentals and technicals you apply to an earnings trade, there is absolutely no edge, and any trade that you would put on will be offset by a certain amount of risk. Always. So now that we've talked about earnings and Volatility Crush and how to recognize which one of these you would want to do, let's talk about how it would be most useful in a normal trading environment. Okay, so we can go look at SPY right now, and we can talk about the kind of week that we had in SPY, the kind of week that we had in the market, really. Due to tariff talks, we had a very volatile week, and we came down to a cog level. We've discussed those quite a bit here at the Bullish Bears. So with this uncertainty in the marketplace, we've had a very nice spike in volatility, and the resolution for the tariffs has not been finalized. So there's really not an answer yet of what is going to happen to our marketplace. What we do know is that with the increased volatility comes increased movement. And so if we were thinking about participating in this volatility, we could put on a strangle or a straddle looking to see a break to the upside or the downside in any product, but for our purposes right now, for SPY. So now with this kind of trade, we just need SPY to not stay still. And if we give ourselves enough time, we could absolutely put a trade on here that can be profitable. So we'll just unlock some of these and try out a few different dates. Now these are halves, so it's not wanting to agree. There we go. All right, so now you can see that I've greatly expanded the trade, and we'll put it back closer to the price of SPY right now, the 289. Try to center our apex with price. Now you can see I do need a big move, right? And in the longer grand scheme of things, I could absolutely get that move in SPY. Since we moved to June 21, we want to move our calendar to June 21, maybe even June 22. And it doesn't matter. There's no wrong or right answer here. The date that you see here on the options, that's the day that you lose control of the option. But that's not its real expiration date. The option expires the next day and is handled at that point by the Options Clearing Corporation. But your last day to have anything to do with this option is on the 21st. Right? By the end of the day on the 21st, you will no longer be able to buy it, sell it, or do anything else with it. Roll it at 4 o'clock on June 21. It's no longer something that you can do anything with, but it's not expired. And that's why we can choose either date. We can choose the 21st, or we could look at the 22nd when the OCC deals with it. What we really want to know is how far can SPY move between now at May 11 and June 21. All the area here in gray is the expected move. 68.27% of all movement within SPY between now and June 21 will be in this area. Now, can it break above? Oh, yes, absolutely. Stocks break their deviation all the time, and this is one standard deviation in price movement. And it could absolutely break outside of that. But this is what the norm is, and this is what the normal expected move is for SPY between now and June. So we could see that a strangle or a straddle for June 21, SPY could absolutely give us a very profitable move. But as time goes by, we will start to sink into this valley of loss. So we do need a move. We can't just languish here waiting forever for the move that we need. And we can look at the day step, and we can set our date up here. So for this trade, we can go to June 21, which means we can spread these lines out a little bit. So now every line represents 9 days of time. And this box over here is showing us where our loss would be by June 16. So the yellow line here represents June 16. Anywhere that SPY would be inside of here on June 16, that would show us where our profit or loss would be. So you can see that as time goes by, we would take more and more loss in this trade if we didn't see a move to these break-even spots, these red dashes here. That's the break-even for each one of these dates. You would need SPY to move at least that far by May 20 to start to see profit, and this far by May 29, and then this far by June 7, and by this far on June 16. All right, so this helps you see visually what you need out of SPY, what your expectations should be. Can we see this move in the market between now and June 16? Absolutely. We're in a very volatile market, and you can see the volatility has kicked up greatly. And a really great way to try to visualize what does that mean that volatility picked up. Look how small these candles are. And then look when we had a spike in volatility and we had much bigger candles. Now this is a daily chart. So 1 year daily chart. So every candle is a day. And when volatility was low, SPY didn't make very big moves in that day. But when volatility got expanded, SPY started making a lot bigger move on a day-to-day basis. And right now, we're at a higher volatility than we have been since all the way back to January after this massive rally from the Christmas crash. So putting on a trade like the strangle or the straddle in heightened volatility, that would be a great thing to do if you're the one buying it. But you wouldn't want to be the one selling it right now. because if you're the seller right now, you need price to stay put. In a high volatility environment, things are expected to move. That's volatility is measuring movement. So you want to have a very strong concept of what's going on in the market and what is the volatility like in the product you're about to trade. If you're going to be the seller, you want to sell the option in a very low volatility environment so that you don't see a lot of movement. But if you're the buyer of the strangle or the straddle, then you want to be doing that in a high volatility environment so that you can get a move beyond your expected ranges. Now, there's no hard and fast law on really good strategies to do the strangle or the straddle beyond the criteria that we've already talked about with looking at volatility and understanding the metrics for your trade. But if we go back to June and set this to 15, here's my expected move for this strangle. The strikes that I used are how I try to set this break-even point to the same distance as the expected move, because I want to make sure that I can get paid in my trade. All right. So here for an example with this strangle that I sold, I need to make sure that the expected move is within my break-evens, because at that point, if SPY passes my break-evens, I'm taking a loss by expiration. So I have to ask myself, how far can SPY move between now and May 15, and is it expected to go beyond my strangle? And I can choose the strikes to help me fit those break-evens. So for an example right here, I've got the 290, and you can see that that's where this starts to curve. My flat area here is developed by the two strikes that I chose, the 290 and the 287. When we start to zoom in here, here's the 287, here's the 290. That's the flat area. From there, we get our shape down to our break even. So if I had the 289 and the 288, well, now you can see I've got a very small flat plateau here, and the expected move, or the expected move is beyond my break evens. So this is saying SPY could absolutely land in my loss area, and that my trade is not big enough. I'm accepting too much risk. But I don't need to take the trade all the way out to the break-evens. So I don't have to take this up to 293 and down to 283. I don't need a plateau this big. At that point, I'm taking so very little reward for such a very big risk, right? So this is extreme. I don't need to go that wide. Instead, I'd want to try to find that sweet spot. There's the 292. There's the 284. You can see I brought it inside just the apex here. The shape where I lose the plateau is now inside the expected move, but my break-evens are not quite as centered as we'd want them to be. Right? And this is where we can start to change our trade mechanics to fit the expected move. Okay, but we don't need our plateau to be the edges of the expected move. We just need the break even to be the edges of the expected move. That can increase our profit potential, and it could decrease our risk by developing the trade with break evens lined up at the expected move instead of just our plateau. So right here you can see I found the sweet spot with the 291.5 and the 285.5. I would collect a 191 credit and I would need SPY to stay within this expected zone here to keep the credit between now and expiration. Now, if I didn't hold this all the way to expiration, then my profit potential would be based on this green line. Normally, we recommend at the Bullish Bears not to hang on to a trade into expiration, but rather to get into and out of every trade with a target profit based on percent. So if I'm looking at a trade where I collected $190, I would look to exit this trade perhaps at 50%, meaning I would buy it back when it was somewhere around $93 to $95. Right? That way, we're not trying to accept the additional risk in volatility. We just want to take our profit, get into a trade, hit our target, get out of the trade. Right? Get in, hit our target, get out of the trade. You got to have realistic expectations of profit. You need to stay consistent in your trade dynamics. So setting target profit goals is a very good way to help you increase your win rate and grow your account consistently. So to review really quick, when you sell a strangle, you are forming a trade where you want price to stay in the same spot. You want to put these on in a low volatility environment so that you do not see a big move. You also want to put them on if you're expecting a crush in volatility, because these will expand as volatility gets crushed. If you are buying a strangle or a straddle, then you want to do this in a high volatility environment where you could absolutely expect to see a big move in price to break beyond the valley of death here, or the valley of loss. You would not want to buy a strangle or a straddle for an earnings event because it would get crushed when the volatility gets crushed. So I appreciate you watching this video, and I look forward to seeing you at the next one.